at the time that it is issued, meaning the original term to maturity. And then the next 5 numbers, they are the date of maturity of the bill, which is 16th of, H stands for the month of maturity of the bill, which is August, because H is the 8th letter of the alphabet, 2024. So if you look at the 364-day bill, 14th of February, 2025. Okay. We talked about how bills are, bill valuation is based on the 364-day standard, not a 365-day, but a 364-day day count basis, because bills always, 91 days are divisible by 7, 182 days are divisible by 7, and 364 is divisible by 7. Always issued on a Friday, maturing on a Friday. Then we talked about call money. Call money, which we said was essentially of Fed funds, is the term that is used in the US. Essentially, interbank borrowing, right? Overnight, unsecured loans borrowed among banks. So these are very unsecured. Unsecured means there is no collateral involved. But these loans are very low risk loans because, one, they're very short term. Two, they are among high credit borrowers, right? High credit quality borrowers, right? Banks. So we talked about Fed funds. Then we talked about repo agreements, where we said repo agreements is essentially an agreement to sell a security a sale of a security with the agreement to buy back. Repurchase agreement to repurchase, agreement to repurchase, right? So it's a sale of a security with the agreement to buy back. And we said, although it is a sale of a security with the agreement to buy back, the underlying transaction is the cash transaction. The cash transaction, where the repo shows you when the security is sold, there is cash transferred, right? An additional amount of cash, which is essentially interest. So this is like a collateralized borrowing, a collateralized borrowing. So what is a repo agreement? Essentially, a repo agreement essentially is a collateralized loan. High quality collateral, because 99% of repo agreements are on government securities. Less than 1% of repo agreements can be on or are on, right? It's not that more than 1% can't be on, but mostly what you see practically in the market, very few repo agreements you will see can be on things like debentures, commercial papers, trust certificates. You can have corporate debt-backed repo agreements as well. It's just the underlying. It's a sale of a security with the agreement to buy back. Okay. So on the repo side, the person is taking a loan. And we say the exact opposite side of this transaction. Sale of a security with the agreement to buy back. Exact opposite side of the transaction is purchase of a security with the agreement to sell back. This is called a reverse repo agreement. Reverse repo, purchase of a security with the agreement to sell back. So, while there is a sale of a security with the agreement to buy back, right? So here you have the sale of the security with the agreement to, sale of security with the agreement to buy back, correct? So the person A is selling the security. Person B is buying. Purchase of a security. Right? With the agreement to buy back in a repo, he buys back the security. Person B is selling back the security with the agreement to sell back. So repo and reverse repo are essentially the same transaction. It's the two sides of the same coin. Okay. One person agrees to sell with the agreement to buy back. The other person agrees to buy with the agreement to sell back. It is the same exact transaction. On the borrowing side, you have a repo agreement where you sell the security with the agreement to buy back. So what is the opposite? The lending side. Reverse repo is the lending side of the transaction, where if you're an investor, you are engaging in a reverse repo transaction, right? So from the investor's side, it is a purchase with the agreement to sell back. When you purchase the security have to give money. That's your investment, right? And when you sell it back, you get back money with interest. That is your repayment of that loan. So reverse repo is the exact opposite side of the transaction. And I told you in Sri Lanka, practically, repos generally get defined on the side of the bank or primary dealer, not on the side of the investor, right? So if investors are transacting in the market, usually when we talk about a repo agreement, although the investor is not borrowing, we define it from the side of the dealer or the bank, right? So the bank engages in a repo transaction. Investor also says, I'm doing a repo, but really he is on the reverse repo side. Okay, so they're just talking from the bank's side of the transaction or the dealer's side of the transaction. Obviously, when two dealers or two banks do repos or reverse repos, then it's important to define what is the repo side and what is the reverse repo side of the transaction. So that's where we stop. We did the sum on how the collateral is calculated on the haircut for the collateral, because we said generally in a repo transaction, although there is a sale of security, the money that is transferred is not the same as the amount that is worth, that the security value is worth, right? So if the security is worth 100, the money that is transferred for that transaction on that sale is not the same. The money that is transferred is with a haircut, a lower amount. Why is the money transferred a lower amount? Because this is essentially a loan, a collateralized loan, and you want to keep a cash buffer. And we said the cash buffer, the initial transfer, the cash buffer maintained at the initial point the transaction takes place, is based on the maturity value, right? Is based on the money that the lender is supposed to get back at maturity, and there is a discount to that. So it spoke about how there is a difference between the market value of the collateral and the face value of the collateral. So we come today to negotiable CDs, negotiable certificates of deposits. What are certificates of deposits? What are certificates of deposits? People who work in banks would know, right? CDs?
I don't know, like it's this I'm talking about like early days of my banking, ma'am, like around 2007, 2008. It was it was an instrument where you can invest anonymously.
Right. So
Get a certain return at the say it was like if I remember correctly, the CDs were at 500 rupees face value and 1 million face value.
exactly. So these are essentially again instruments that, okay, a lot of CDs are issued by banks, right? Certificate of deposits are issued by banks, but they're not FDs. If you remember fixed deposits, we can't trade fixed deposits, right? If I buy a if I invest, in a fixed deposit, if I invest in a fixed deposit, it is for that period of time, it is under my name. I can't suddenly say, no, I want to get some money fast. I will give it to somebody else and get the money. We can't trade fixed deposits, but CDs have the ability to be traded. CDs are essentially a certificate, right? That promise, it's like a promissory note. It's a promise to pay back after a certain period of time. CDs are usually issued by banks, right? Or issued by banks. So in the CD, you have a bank that's promising to pay you back after a period of time at maturity. So there is a face value to the CD that says the bank promises, like you said in your example, the bank promises to pay back 500,000 rupees at the end of the 3-month period. Right? Today, the bank issues this at a discount. Because obviously, the bank can't issue this at 500,000 rupees now. If he's promising to pay back 500,000 rupees at the end of the period, you can't issue it at 500,000 rupees today. Okay. So, CD is issued at a discount, just like a treasury bill. But of course, treasury bill is an instrument that the government uses to borrow. CD is another way that banks have used to borrow. And the interesting thing about CDs is they are bearer instruments. They're bearer instruments, right? Bearer means whoever holds that certificate is entitled to get the cash. Okay. So technically, even though you can have a name in the CD that says, this is a CD which is a promissory note or a promise by this bank to pay back Mr. X on this date, right? This amount of money, Mr. X can at some point decide to sell the CD. Okay. He can sell the CD. In the back, he can endorse it and say, I've sold it to Y. Okay. So like this, the CD can get transacted in the market, and at the end of the period, at maturity, who comes to the bank to reclaim the money might not be the original investor. So Central Bank has stopped CDs now because of KYC issues, right? Because you don't, so that's what you meant by anonymously, because the CD, you can essentially, I'm not sure, I don't know whether when you initially started in Sri Lanka, whether it was anonymous, but certainly it was tradable, right?
The thing was like there was a book where the book was with the managers, the
Right.
details are written down, but it was not shared with anyone else at the time of encashing the CD. Also, the same process was there, but it was confined to the manager's view only.
Right. Okay. Okay.
I mean, that's how it happened in branches.
Understood. So that probably is part of the reason why Central Bank, essentially CDs are allowed. It's not that CDs are not allowed, but now you have higher KYC rules with everything and everything. So because of this, you don't see a lot of CD transactions. Obviously, you don't see CDs being issued by banks, because KYC would mean that it becomes difficult once you have once you do the KYC, give this to a certain or take a deposit from a certain person in the form of CD. And if that person trades it, then where does the KYC go, right? So that becomes a bit of a hassle. So probably the reason you don't see banks issuing CDs anymore. But CDs are popular in other markets. And it is another way for you to raise money. And it is different from FD. That's why FDs are not defined as money market. FDs are not tradable. CDs are money market. They are tradable instruments. They are discounted instruments. They are bearer instruments. And because they are discounted instruments, so today I buy this CD at, let's say, paying 450. And then sometime later, depending on where the interest rates are, I can maybe sell it at 480 to somebody else and get my money when I want to. Okay. If I go to a bank, okay, if interest rates have come down, remember we talked about how interest rates are inversely related to the value of like your treasury bills and treasury bonds and debentures and all of that. So this is another tradable financial instrument where interest rates are inversely proportional to the value of the security. If interest rates have gone up and I wanted to sell the CD, I can even make a loss. I can. Not necessarily, but I can, right? Even make a loss if I wanted to sell the CD. In a bank FD, you know for sure if you want to, if you have a bank FD that today you invested a certain amount of money and you think you're going to get a certain amount of money at maturity, right? But in between, if you wanted to premature because you're getting a certain rate, let's say you're getting 12% from this bank FD, right? And that's how it goes to 600,000 after a certain period of time. But if I want to premature, you know that I will get this my 500,000, which is my original value, plus a penalty interest, or say I was promised 12%, but maybe I'll only get 4% interest. So these are features of a CD. CDs are not as popular in Sri Lanka anymore. Similarly, you have another type of promissory note called CPs, commercial paper, CPs. So commercial paper is a way that companies use to take debt, borrow. from the markets. So instead of going to a bank and borrowing money, they can come to the markets and borrow money or take debt in the form of a commercial paper. And this is short-term debt. Long-term debt, you would look for debentures. Short-term debt, you can look for commercial paper. What are commercial paper? What is commercial paper? They are essentially unsecured promissory notes. What do you mean by unsecured?
There is no collateral involved.
Yes, there is no collateral involved. So this is essentially you are relying on the ability of the company to pay you back. So as an investor, you are at higher risk. Not that, it's not that there is like always when you invest somewhere, there is a risk, right? Compared to a secured instrument, you are at higher risk in an unsecured instrument because you have to rely on the company's quality or the company's credit quality ability to pay back. If you had a security, like if the company had given you, like, let's say, a land or building or some sort of property, then if the company doesn't pay back, you sell the collateral and you recover your money. But unsecured means nothing has been given. You have to put faith that the company will be able to pay you back. Which is why in markets like the US, you will see that commercial paper is raised by companies with very high credit quality. Very high credit quality. In Sri Lanka, you will see that commercial paper can be raised by anybody. Even in the US, commercial paper can be raised by anybody. You have the issuers. Issuers will always want money and anybody can look at issuing. But it has to be purchased as well, right? And commercial paper will not be purchased by anybody. Most of the time, because they are unsecured loans, you will restrict it. It's buyer beware. So the investor will usually restrict it to very high credit quality companies. AA and above, for example. Versus in Sri Lanka, it's again buyer beware. If there are people willing to buy lower credit quality companies' commercial paper, then, there's no restriction in terms of who can issue commercial paper. It's simply a company borrowing from the capital markets. It is a promissory note that promises to pay back the investor after a certain period of time. And correctly, commercial papers are also discounted instruments. They have a face value. They are bearer instruments. Again, commercial paper can be traded. Whoever's name is finally on the paper is the person who will get the money from the company. They are bearer instruments. So it carries the same features as treasury bills, CDs, right? Only difference is what? Commercial papers are issued by companies. These are ways companies borrow short-term funding from the capital markets. So this is an example. If you can see this certificate that is there, it is an example of a commercial paper, an actual certificate that has been issued by a company. I've deleted all the information, but so if you see, right, it says this company's commercial paper issued on. So technically speaking, this issue date is not required. Issue date is not required, right? Only the maturity date is required. So this is a 2020 commercial paper issued on 27th of August, maturing on 27th of November. So this is a 3-month commercial paper, right? But there's no harm putting this. It just impedes tradability. So technically, you don't need the issue date, but there's no harm. There's nothing wrong with putting it, right? So this commercial paper, you don't need this issue date. Essentially says on this date, 27th of November 2020, without days of grace for the value received, this company promises to pay back the sum of this amount to this person. That's it. That's all there is, right? It is a promissory note by a company that promises to pay back a certain amount of money on a certain date. And this person who is here can take this piece of paper. Suddenly, if they want money, they can take it to somebody else and say, I have this promissory note, this piece of paper that promises to pay me back a certain amount of money on 27th of November. Will you buy it from me because I need money today? and you can negotiate and decide on a price, and that way the commercial paper can change hands, and whoever holds it last. So at the back of the paper, you will endorse it and you will say this paper has now been transferred to this person, right? And whoever has it last can take it to the company, and the company will pay the person who brings it in. So do you see here in this commercial paper and even in CDs, right? Technically, you don't need a rate. Even in treasury bills, you don't see a rate, right? Written on the face value. Why? Why? Why don't you see a rate written on face value?
Because they are discounted instruments.
They are discounted instruments. The rate is essentially the difference between the price you pay and what you get back, the face value at the end of the period. So the rate can be different to different people because this instrument is tradable. And tradability gets impeded when you put the rate. Because say, for example, last year commercial paper was issued at somewhere around 30%, right? Let's say, for example, last year commercial paper was issued somewhere around 30%. And today somebody wants to sell it. Interest rates have come down. So last year when the commercial paper was issued, it might have been issued for every 100 rupees, maybe at around 70 rupees. Just put in numbers, right? Maybe at around 70 rupees. Today, interest rates have come down so much, probably he can sell that commercial paper maybe at around 90, 95 rupees. Okay. So at the end of the period, face value, you get back 100. Now, this person, if, for example, the buyer, the new buyer, understood that this person purchased the commercial paper when the rates were 30%, the new buyer will also negotiate higher rates than there is in the market, right? Because, although market rates, the commercial paper should be trading at around rates of, let's say, 12, 14%, depending on the issuer, this person has purchased it at 30%. He can afford to give a little bit of that money to me. So we will negotiate it. The buyers will try to get the maximum, right? They don't want to pay the high price. They will always try to pay the lowest price possible. And negotiations become a little bit tricky when you know what the rates are. Same way, if you know what the issue date is, you can still make a fair guess what the rates are, right? That's why issue date also is really not relevant to be put on the paper. It can be, there's no harm, but kind of impedes trading a little bit. So commercial paper, I told you, are discounted instruments. So just like even CDs, same formula applies, right? Just like treasury bills, what happens? At the end of the period, you get back a certain amount of money, and that money is promised through that certificate, which has a face value, right? So we talk about it in terms of each unit being 100. Your face value being 100 per unit. So today, the price of this certificate will be different to the face value. It will be a discount to the face value, right? More often than not. So what is the price? It is the face value discounted to today's value. 1 plus R. Remember I said to the power n, but because instruments less than 365 days or less than 1 year are generally we use simple discounting, not compounded discounting. So we don't take it to the power n, we look at R, how many days to maturity, divided by, this is the actual 360, actual type of instrument. So it's either 365 days or 366 days. Because these are instruments issued by companies, these instruments could be actual basis. Or actual 365 basis. Okay. What does that mean? The number of days, the numerator, is based on the actual number of days between the trade and the maturity. right? But the denominator, if it's a leap year, if we use actual, is divided by 366. Usually companies, just for ease, always divided by 365, even if it is a leap year, right? That really depends on the investor and the company. So that's your trading preference. So it's either actual or actual 365 type instrument. Because there's so little commercial papers in the market, technically it should be actual instrument, but certain investors, when they negotiate, they will base it on actual 365. Okay. Any questions here? Let's try an example.
Miss, so this is basically a bearer instrument, huh?
It is a bearer instrument. That's correct. It is a bearer instrument. Bearer means the person who has it, who bears the paper at the time of maturity, will get the face value. Let's try some. Try this. So send it on chat, please, and send it on direct message, right? Don't post it to everyone. I would appreciate that. Thank you. So we use an actual 365-day count for this. Viraj, just waiting for a couple of other answers. Yeah, Niraj, correct. Nimasha, correct. Hiraka, yes. Sampath, check it again. There's something wrong. I think the mistake is, see, it should be face value divided by 1 plus day divided by 365, right? So we're using 365-day count convention, not 366. Here, this part should be one single calculation. I think that's where it is wrong. I think. Prasad, correct?
Okay, madam.
28, yes, correct. Another correct. So that's very easy, right? Good. Everybody's getting it. 56, check it again. You had to discount it, divide it. So it has to be lower. Your value has to be lower than 750. It can't be higher. How much money did the company raise? So you have company A, which issued a 182-day commercial paper. So what is it doing? It's promising to pay back investors after 182 days. After 6 months, 750 million. Today, what is the price they're issuing at? That's the amount of money they are going to raise. So the 750 million commercial paper can be that by multiple investors or single investor. It can be bought by multiple investors. Some investors investing 10 million, some investors investing 100 million, some investors investing, let's say 500 million, right? Altogether, bringing it up to 750 million. Usually, some companies, very few companies give small scale commercial paper, right? But usually commercial paper investments, the minimum type of investment that you see is 10 million. Very few, not more than 1 or 2 companies in Sri Lanka does offer it to investors at small scale, but that's a different business model that they're running there, right? Usual commercial paper issuances go with a minimum investment tick size of maybe about 10 million. That's up to the company because it's a customizable instrument, right? How much money did the company raise? So what is the value of this commercial paper today? That would be the amount of money the company raises. So Janani, yes, correct. So 100, so you're getting 750, face value is 750. Divided by 1 plus R, which is 14%. 14 has to be looked at. This is for the entire year, 14% for the entire year. For per day, it's 14 divided by 365 into 182 days, right? So this part is one part. And then you add 1 and divide it, and everybody's pretty much most people have got the correct answer, 701.06 million. So the company raises 701.06 million today. That's the company. And you have all these investors who have purchased commercial paper. And at the end of the period, the company has to pay back in total 750 million to all of these different investors. Okay, try the second part. Okay, Niraj, let's see. Um, 61, I think that seems a little too low. Something is off. 28, a little too rounded up, but in the same right direction. Oh. So I'm getting three different answers, very close by, but different, right? Niraj, 28, and Divankar, three different answers, but very close to each other. Party. But it's different, right? It's not too close. Correct one seems to be 28, though. The date's answer is correct. Number of days is not right here. That's the problem. Nimasha, yes. Janani, yes. 61, are you using 366 days? That might be the reason. If you're using 366, that's okay. Prashant, are you using 366 days?
No, ma'am, I used 365 only. I got 95 as the number.
But yeah, so 365 is okay because I said you use 365. That's okay. But the actual number of days in the numerator. So are you using the fact that it's a leap year this year?
Pardon?
It's a leap year this year.
Uh, no. There was one day mistake there. Sorry. Yes.
So Janani, correct. Okay. So here, now the important thing is to figure out, it was issued on 15th of February. When is it maturing? So it's maturing 15th of February. Plus 182 days. So 15th of February plus 182 days, when is it maturing? Johan, I think again the mistake is you're not taking the actual number of days into consideration for D. Actual number of days. Take into account this year is a leap year. So 15th of February plus 182 falls to
15th of August.
15th of August, right? You have to check that because the maturity date is the most important date. Issue date is not important. So 15th August 2024 is when this commercial paper matures. Now, remember we all talked about this when we did treasury bills. It's about the period that is left, right? Present value of future cash flows. Past has nothing to do with it. Past is past, it's gone. So present value of future cash flows, right? So now what is D? D is the number of days from 13th of May to 15th of August. So if you all are not getting 15th of August, that could be because you're not taking into account that February is a leap year. 29 days in February, right? If you all are getting 16th of August, that's because February is a leap year and you're not taking into account. No, you're not taking that into account, right? So 15th of February plus 182 days is 15th of August, 2024. So how many days from 13th of May to 15th of August?
95.
95. Is that right? I didn't get that. Is that right?
It's 94.
94. Sorry.
94. Okay. Thank you. So 94 days. So after that, it's very easy, right? After you figure that one out, so now he has to get 10 million. So this is the person we're talking about. He has to get 10 million at the end of the period after 94 days. So how much sales proceeds would he receive? The buyer needs to get 10 million after 94 days at a rate of 12%. So what is the sales proceeds the seller would receive? It's how much the buyer would pay him, which is face value of 10 divided by 1 plus R into number of days, 94 days, divided by 365. Right? I told you all to use 365-day count convention because a lot of the time you see here, there is no proper method of doing it. You either use the actual 365 or actual. If we used actual, then what should you be using for this year?
366.
If you use the actual day count convention, what should we be using here? 366. Right? 366 because from 15th February plus 182, yes, there was February 29th was in between this. So there it was a week to Sorry, I didn't mute everybody, right? Apparently, I had muted everybody. Something happened. So, right. So then we would be using 366, right? Which is correctly the way we should be using commercial paper, but in Sri Lanka, we see we use it both ways, and just for ease, I just said use 365, right? So how much are you getting here? 9.7. Now, what is the investor's non-annualized holding period return? This investor purchased this paper at a certain price on 15th of February. On 15th of February, he purchased this paper at a certain price. First, you have to figure out what is that price. And then he sold his paper at 9.7. So what is his return? That's what the second part is asking. Those of you who sent me answers, just check that you all have used the correct numbers, right? Yeah, Sampath, that way also can be done. That's okay. As long as you use 94.
Madam, for the last one, the answer was like 9.697 something, was it?
No, it's 9.70 something.
Oh.
It's 9.7002. So Tivanka and Niraj, you have two different answers. I'm waiting to see what the others are also saying for part B.
No, mine must be wrong because I took a different date. Yeah.
Okay. Anuradha, return is on percentage terms. Always remember in finance, we don't analyze using absolutes. So you need to remember always when we do anything in finance, you have to keep it in percentages so that it makes it easy to analyze the next part.
Yeah.
Okay, thank you.
For the first question, like 2.1 or 2.8.
Right.
So they're saying 10 million face value commercial paper and he wanted to sell it on May 13th. So that means for that period, the rate that is applicable, so based on how I did it, it was for that period, I calculated the rate to be 12%. So first I discounted it to 15 February, and then I added the interest of 12% up to.
No, so okay, I understand what you've done. So how to explain that? When you buy this instrument, you purchased it at saying that you want a return of 14%, right? That's why you discounted it at 14%. No, you said you wanted a return of 14%. That's why you discount the instrument at 14%, right? And so you paid that amount. When you pay the on 15th of February, whatever that price that you pay, that price is based on you getting a return of 14% by August, by 15th of August. Now, when you're selling it before it matures, right? You see this better when we do the bond questions, but when you're selling it before it matures, the return that is promised to you will not occur because the issuer only gives you a return. You sell it in the secondary market to somebody else. The issuer gives you a return based on the fact that if you hold it until it matures and you go back to the issuer, then the issuer will give you back your face value and you will get the return that was promised to you. Right? But if you sell it in between, then you won't get that return. Now, when you sell it in between, always you look at it from the view of the buyer, because the buyer is the person who's concerned about the fact that what is he getting. So the buyer can't buy at a certain price and you sell at a certain price, and the two prices have to be equal. So how do we always calculate it? Always we calculate it based on the present value of future cash flows. Future. Why? We say the person who this instrument is relevant to now is the person who's buying it, right? Not the person who's selling it. The seller it's gone, right? You can negotiate the rates. Rates are not a problem, or you can negotiate the prices, but the price will be based on the fact that buyer's future cash flows, not the fact, because the buyer doesn't know at what rate the seller bought it. So how are you saying, right, when you're negotiating with the buyer, I'll sell it at 12%, I'll earn an interest of 12% and sell it. The buyer doesn't know at what price you purchased it, right? So always when you're selling, you look at what is transparent. What is transparent is future cash flows. So and the buyer knows that's what he's going to get if he holds it until matures. So your calculations will be based on today's value of what the buyer will get in the future, even if you're looking at it from the seller's side. Does that make sense to you?
Yeah. Because I took the 12% rate, considering that 12% is given from
From
50.
the time that you purchased it, right? But no, that's why. Yeah.
So,
But that's what we're doing in part B. Now you sold it at this price, no 9.7. So you purchased it at a certain price. What is the actual return that you have made? I'm still not getting a. Janani. No. Everybody's giving me different rates. Close, but not the same. So what do you mean by non-annualized return? The fact is, at what price did you purchase this? Let's look at that. At what price did you purchase this?
9.34.
9.34. Okay. How do you get that? That is 10 divided by 1 plus 14%, right? Not at 12%. No, when you purchased it on 15th of February. At that time, the company issued it promising 14% return. So you purchased it at 14% for 182 days. So you're getting 9.34, is it?
9.347.
It was 7. Okay. So what is your holding period return? You held it from 15th of February to 13th of May. Right? For 182 minus 94 days. Because you can calculate the number of days, but we know that this was 94, right? The future was 94 more days to maturity. So you held it for 182 minus 94 days, which is how much? 88 days. Is that correct?
Yes, ma'am.
Okay. So you had it for 88 days and you purchased it at 9.347 and sold it at 9.7002. What is your return? Return is always in percentages. Return is always your capital gains and any other cash flows. In these cases, no other cash flows in commercial papers, CDs, CPs, GSEC, treasury bills, no other cash flows, right? But your return is always like dividends or coupons or whatever, any other cash flows, plus your capital gain as a percentage of your initial investment. Right? What is your here? There are no other cash flows. It's only your capital gain. You purchase it at 9.347 and you sell it at 9.7. So your return is 9.7 minus 9.347 divided by 9.347, which comes to 3 point. Why is still everybody giving me? Okay, I have so different the answers. Three point 774. Okay. So we have.
Excuse me, madam.
Go ahead.
Can you please explain that how we arrive at the 94 days? That is actually my confusion. Is 94 days, madam? From because he was supposed to sell at May 30th, May 13th.
Okay.
So how calculate that 94 days, ma'am?
So how we got the 94 days?
Yeah,
Concept?
yes, madam. Yes.
So 13th of May.
Yeah.
13th of May, and you know that it's going to mature on 15th of August. Is that okay?
The 15th of August. Okay.
Right. So that's also a calculation from 15th of February plus 182 days. You have to find out that this is 15th of August maturity date.
Okay.
So once you have 15th of August, then 13th May to 31st of May is how many days? It's 18 days there, right?
Yeah, 16. Yes.
13th May to 31st.
13 May. 13 May to 31st. Yeah.
Yeah.
Yes.
18 days.
All right. Okay.
Plus May, June, July, and August has another
Yes.
15 days.
Yes.
Which gives you 94.
Yeah. Thank you. Thank you. Right.
So once you have 3.77, then the next part is essentially annualizing it. 3.77 is for 88 days. Correct? We run out of colors. 3.77 is for 88 days. So what is the annualized R? $3.77 is for 88 days. So for 365 days, we're using 365 only because for everything else we've used 365. 365 days is a 15.64. 50.64, 50.68. There'll be a small rounding error depending on the number of decimal places you would have used. Okay. So that is your annualized return. Now, the question is, how are you getting 15% returns? This person is getting a 15% return. When he invested in this, he only asked for a 14% return. How does that happen? He sold it in between and he's got a 15% return, 15.6% return.
Capital gains because the interest rates have come down.
Yes. Capital gains because the interest rates have come down. Right? So capital gains higher than 14%. Interest rates, when he purchased it, was 14%. He sold it at 12%. Interest rates have come down. The next person is buying it, asking only for a return of 12%. Interest rates have come down. Interest rates coming down means the value of the security goes up. Interest rates and the value of the security are inversely related. So what is happening? He's selling it and he's actually making a higher return. For the period that he held it for the 88 days, he's making a higher return than if he holds it to maturity. If he holds it to maturity, he's going to get a 14% return. But because interest rates have come down, he can sell it and get a better return, 15%, 15.6%. And this concept is true for bills, CDs, CPs, bonds, debentures, and interest rate sensitivity is higher the longer the maturity. So because of this, you see that bonds will show you better interest rate sensitivity, meaning that you get even greater returns. So when interest rates came down from 30% last year to like right now at 12%, 11%, you're going to see massive capital gains, even depending on the type of bond you have purchased, even in the ranges of 75%, 88%, so on.
Madam, there's a small question like about the previous calculation.
Okay.
Now see, initially it says rupees 170 million face value. Commercial paper was issued for 182 days. So now that one, when we are going to this, say the second part, like if we can we take like 750 for 750 million face value, we has paid say some 700 and odd million. Now for the 10,
For 10, you can say you can take it proportionately.
Yes, proportionately distribute. Segregate that, and for the
As long
second
as
part,
it's the
we can,
same rate, you can proportionately segregate it. That's correct.
yes. So then, based on that, we can do this 88 days calculation and arrive at the same rate, right?
Yes, you can't do the part A. 2.A you can't
Right.
do.
Yes.
But
Once like
for 2.B, you can do it that way. That's okay.
that way also, right? Okay. Okay. Thank you, ma'am.
Miss, just one thing now, when you sell on May 13th and take that capital gain, your reinvestment is at likely going to be at 12 current rates.
That's right.
So then if you take the 182 cycle,
You might not be making a 14%.
Yeah. So
Yeah, I mean, that is
Yeah.
definitely something that you have to look at. So it's a fair point. You have to look at, I mean, for things like commercial papers, treasury bills, the capital gain is very small, right? So within that cycle, that whether you will make back your money, that's a separate calculation that you will have to do. So the question is, I said you can sell it and you can make a capital gain. If you held it until it matures, you are going to get a 14% return. But because you sold it beforehand, your return is now actually 15.5%. So it could be you're selling just to not to make a capital gain, but because you need the money, right? So if you sold it when rates have gone up, then you will make a loss or you will make a lower return than 14. But here you made a higher return than 14. But if you're selling it for the purpose of making a capital gain, then correctly, like you highlighted, correctly, you have to look at your reinvestment as well, right? After you make this 15.6% capital gain for the remaining period, for the remaining 94 days, where are you reinvesting that money? And from that reinvestment, can you catch up more than 14%? Otherwise, it doesn't make sense for you to do it for trading purposes. You're correct.
So that just because you have a capital gain at a certain point in time, it doesn't mean that considering reinvestment.
You have to check
You always
considering
need-
reinvestment. Definitely.
Okay, thank you.
Okay. So that's on commercial paper. We come to Eurodollars, the last instrument that we will touch on, right? So Eurodollars are essentially, it's not really an instrument, but it is a concept. How do I say? It's a concept. It's a way of defining commercial papers or CDs or whatever in a different way, right? Because what is Eurodollars? Eurodollars essentially represent dollar-denominated deposits held in foreign banks. When we say Eurodollar, we're talking about US dollar-denominated deposits held in banks outside of the US. When we say foreign banks, banks outside of the US, right? So US banks can hold US dollar-denominated deposits. Similarly, you know that in Sri Lanka, we have US dollar denominated deposits. These are called Euro dollar deposits. In the UK, they can have US dollar denominated deposits. So, although we just say they're dollar deposits, right? But they're actually Euro dollar deposits. That's the terminology. So, why is this important? Because the Euro dollar market is very active. When you have this like huge amount of dollars in the market, just like, your banks borrow interbank their own currency, like in rupees, you have all this interbank trading that is going on for supply and demand concerns to make up liquidity shortfalls and things like that. When you have that type of money, when you have large amounts of dollar deposits held outside of the US, you can have trading activity that is going on between banks in dollars. Although they are not in the US, trading activity can happen in dollars as well, right? So, actually speaking, when you think about the Eurodollar market, they say from a textbook, they say it was born because of Russia, one of the more communist countries, right? Not one of the more, but Eurodollar markets are one of the most democratic markets when we talk about modern finance. So, how did the Eurodollar market take place? There was a point in time when Russia, before it was split, USSR, they had a lot of dollar deposits, which was held in the US. And, between Russia and the US, there was this Cold War going on. And there was some fear that US would freeze these deposits, right? And Russia would have no access to their dollars. So they wanted to take it out of USSR, wanted to take it out of the US banks. So what did they do? They took that money out of the US banks and they deposited it in a lot of foreign banks, mostly UK. Now suddenly you had this huge influx of cash, like huge amount of US dollar-based deposits that were being held outside of the country. And thus the Eurodollar market was born, because now you had a market with a lot of breadth, a lot of depth, and there was trading that was happening within this market. So technically, we say that the Soviet Union was the birth of the Eurodollar, one of the more democratic markets that you find. Now, what is Eurodollar? Essentially, as long as you have enough dollars, any country can issue dollar-denominated debt. Like, for example, our dollar bonds, they are Eurodollar bonds. Right. But we have now defaulted because we don't have enough dollars, right? But they are Eurodollar bonds. We issued and we borrowed in dollars, and other people invested in dollars. And these were not US investors necessarily. There were investors from across the world in different denominations, and they all invested in dollars with us. It was a Eurodollar bond. So Eurodollars essentially means dollar deposits, CDs, CPs, notes, bonds, whatever, issues of happening in that currency outside of the country of origin, outside of the country of origin. So when we say outside of the country of origin, when you have a US-based, US dollar denominated commercial paper being issued by a company outside of the US, that's a Eurodollar CP. When you have a bank issuing a CD in US dollars, but they are not a US bank, Eurodollar CDs. Right? It doesn't even have to be Eurodollars. It can be Euro Yen. It can be, what is Euro Yen? What is Euro Yen?
Yen denominated
Deposits? Outside of? Yen-denominated deposits or yen-denominated instruments outside of their country of origin, Japan, right? So we were going to issue at one point, right? We had grand plans of issuing yuan, a Chinese bond, right? These are all Euro bonds, Euro dollar, Euro yen, like this, different currencies. What does it mean? It's the currency, it's an instrument in that currency issued outside of the country of origin of that currency. That's it. So Eurodollars are not necessarily a separate instrument. They are CPs, CDs, whatever, sovereign debt issued in currency outside of the originating country. That's it. Okay. So one of the more famous markets of Eurodollars used to be LIBOR. LIBOR is the London Interbank offer rate. That was essentially the rate within which banks among the UK used to borrow. So it was an interbank rate that where essentially you talked about 18 banks, and those 18 banks supplied rates where at what rates that they could borrow among each other. And this average, so they used to take these 18 banks, these were very high credit quality banks like AA rated and above, these banks in the UK, and they used to supply rates, right? And they said, this is the rates that we can borrow at among each other. And this used to be supplied to a central processing counterparty, and they used to take out the outliers, the 4 highest and the 4 lowest was taken out, and the average was published as the LIBOR. And anybody who's working in companies who've taken rates and you use the LIBOR rate, what do you see? This is essentially the average. But then after 2008, you had the financial crisis that happened in 2008. And it was found out later, around 2011 period, I believe, that the LIBOR was being manipulated, because LIBOR was not an actual rate that banks trade among each other at, right? So what they were doing is, this is the rate that banks can trade among each other. These UK banks, these 18 designated UK banks, that they can trade among each other. So they were giving rates that were not true, rates that were beneficial for them. They were colluding together to make sure that they were not becoming insolvent in the global financial crisis. So when you gave a rate that's very low, what happens? Your asset values are inflated, right? So they were colluding, and the LIBOR was being manipulated, and the LIBOR rates were not reflective of actual market situation. So once this is called the LIBOR scandal, so you can Google it up. And once this was found out, it was decided that LIBOR had to be phased out. So now no longer you still have LIBOR because like so many instruments have been issued based on LIBOR, right? If you borrowed in Sri Lanka, a lot of the loans have been issued based on LIBOR, right? Now LIBOR is being phased out. So all the new loans and the old reference rates are being changed. And the USD reference rate is changed to something called SOFR, right? Secured overnight facility rate, I think. Sorry, I forgot that. 1 second. I think it's secured overnight facility rate. Just let me just double check that. Financing rate, sorry. Secured overnight financing rate. So those days, you used to have USD LIBOR, GBP LIBOR, for the for the Swiss franc LIBOR, Japanese yen, euro. Euro used to be called Euribor, right? Canadian dollar. You had different LIBOR rates, right? London interbank rates of GBP, of Canadian dollars, of Japanese yen, and so on. Now, every country has their own different types of rates that they're going to use. So there was a lot of rates that were in debate about, okay, what should we use as the reference rate now that we're going to move out of LIBOR? And this is what has won out: secured overnight financing rate. Right? Secured overnight financing rate. What is this rate? It's simply, if you think about it, the repo rate. Secured overnight financing, right? Secured overnight financing. What is this? This is simply like the repo rate. For designated counterparties, yes, it's administered by the Central Bank of the US, Federal Reserve. Okay. So third-party repos are essentially what is taken to come up with this rate. But if you look at the pound LIBOR, right, the Great Britain pound, the pound LIBOR is based on a new rate called SONIA. So SONIA essentially is an index average, right? It's an overnight index average. This is not a secured rate. This is unsecured. Sterling overnight index average. Sterling overnight index average. Sterling is the pound sterling. Overnight index average, right? So this is based on the unsecured overnight sterling rate. So this table was not in your original notes. I'll send it across in my next email, right? But like this, now what has happened in the euro-dollar market, because of this manipulation, now every single country is using their own benchmark reference rate for all these loans that have been taken outside of the country of origin. So for now, you see that slowly, banks here abroad, they'll be converting to this secured overnight finance rate. So all your bank, let's say, borrowings that you have, earlier it used to be LIBOR +3. Now it will be SOFR plus some other margin based on the SOFR, right? So this is what is happening with the markets right now because of this LIBOR scandal. So yeah, that brings us to the end of this section.
Madam, SOFR is a little bit lower than the LIBOR. So
because it's secured, right? LIBOR is unsecured loans among banks. So LIBOR was interbank. You had the bank's credit risk, right? And it was unsecured. It's like the bank's call money rate. But this is like the US treasuries. repo rates. So SOFR should be a little bit lower than LIBOR.
Thank you, madam.
So we come to the introduction of bond markets. Do you want to take a break now and come back, or do you want to go on till 10 and then take the break?
Quick break would be great.
Okay, let's take the break and come back. Okay, thanks. Sorry, let's reconvene at 10.